Hey guys, welcome to Tribe Tuesday. And this segment, we're going to talk about investing university. Now, let's do a very quick recap. Before that, I'm not a financial advisor, not licensed in any way, and I'm not recommending us to buy or sell anything. This is really ideas that I've experienced myself. I've collated over the years, compiled all these ideas, and I wanted to share with you guys. At least you can get somewhere to start it, so that you do not like blindly follow things. You know what to ask. So, in this particular segment, I'm going to talk about five categories of evaluation matrix. I would like to first apologize because in my title, I talk about 10 financial ratios, but I realized there's at least five categories, and in each of them, I was trying to aim for two, but sometimes there's a little bit more than two. So I'm going to go through them and let's use some practical examples. Now, the whole idea of investing, right, before I go into details, I'm going to show you guys, I use this website called Jita and also Morningstar. In fact, I use a few websites, but these are all mainly free websites that you can access to. And what are we buying when we actually buy a particular stock? When we buy a stock, it's not buying a hope or like a gambling ticket. What we are buying, right, is we are buying a particular company, and specifically, think about it, what we are actually buying is the future profits of the company. Okay, what do I mean by that? Well, you see, upon buying the company, whatever profits they have made in the past, it belongs to previous shareholders. And likely the shareholders have benefited through share price increase or through dividends. Upon taking over the company, you are believing that this company can make money in the future. And when they make money, they generate more profits. Either stock prices will go up or they give dividends. This is the whole key idea. So what does that mean? It means that when we purchase a particular stock, example Walmart, not a financial advice or recommendation. I'm using this because it is something that I thought most people can understand. It's a supermarket. I think most of us know what a supermarket is. So when we buy Walmart, if we buy Walmart, we are purchasing Walmart's next quarter, next year, next 10 years profits. When they make money, some of it will flow to us in some ways, either through dividends or because they make more and more money, they are actually increasing in valuation. When the value increase, the stock price increase. Okay, this is the whole key idea. Now, this is happening in the long run. It gives some time. It does not happen tomorrow. So there's no way to get rich quick. Okay, so that's what I have to tell you guys is. Now, for Walmart, right, let's take a look at some of the key ratios that I myself would like to look at. But think about it. Okay, going back to my slides, there are a few things we are asking. The first thing is we are asking is, since I'm buying a company's future profit, have they been profitable? So the first thing we look at is profitability. So there are a few things that I'll share with you guys and what it means, and we'll look at where to look at it, and we'll compare with some other companies. Second thing is, right, we are looking at cash flow. Now, if you remember from last week's investing university, we talk about cash flow statement. Why is cash flow statement important? Because a company can appear to be profitable, but there's no cash flowing in. Either because their customers are not paying, or maybe something fishy is going on. Creative accounting. We like people to be creative, but we don't like accountants to be creative. Okay. So the next thing is liquidity. Now, liquidity is, in fact, are they borrowing too much? Is that too much leverage? Okay. Now, there are many ways to look at it, less liquidity, but the whole key thing is we don't want a company that borrows too much, even if they are making money, even if they have cash, but if they are borrowing too much money in times of crisis, where 1 or 2 years, sometimes they are not able to make money that year due to some issues. Okay, if they borrow too much, they may be in trouble. They may not be able to return the interest. It compounds, and that's where people get into trouble. Okay, well, you probably heard of people like their income is good, everything, so they borrow a lot, they spend a lot, and suddenly they lose their job or there's a certain pay cut. They can't afford to pay and they go into huge debts. No, this is not something that we want. We do not want companies with huge debts. Now, the fourth thing is this. Now, after we check that they are making money, profitable, they in fact have the money, they are not borrowing too much, we want to see how good are they at making money. Okay, what do I mean by that? Okay, verified, they're making money, but are they making money efficiently? Okay, so what do I mean by efficient? Because if let's say every year when they make money, they can give us the money through dividends, or they can take the money for expansion. So if they don't give it back to us, if they leave it for expansion, we want to make sure that the expansion effort is worth it, is growing at the rate better than them giving us the money, and we can take the money to invest somewhere else. Does it make sense? Okay, so we'll look at some of the matrix as well. Now, the next or the last portion, in fact, it is we can check a lot of things, but if let's say we check every single thing, we are bound to find something we don't like about the company. There's no perfect company, correct? So I'm going to focus on these five things, and you see whether it makes sense for you. The last thing we check is the growth rate of the company. So again, if they are efficient, certain things must show that it's growing. Example, revenue, income, EPS. We will talk about that in a moment's time. So with that in mind, let's go through them one by one, okay? Segment by segment. First segment, profitability. Now, I'm looking at three things: revenue, earnings per share, and book value. So let me show you where to find them first. Going into Jita, I'm going to show you this. Okay, so Jita, when you click on this website, Jita, I'm going to search for Walmart. Sometimes you have to search for the particular company's name. Okay, Walmart. Another thing you will take note is they are listed in various exchange. I'm going to go for the one New York Stock Exchange, but you can choose other stock exchange if let's say you are watching it from that particular country and it's more, let's say, tax efficient. There's no like more advantage if you actually buy from there. So now I'm here at Walmart. You can see summary, financial, fact sheet. I'm going to go to the fact sheet, and this is not default. This is a fact sheet that I've customized. So let me show you how to customize it. Click on here, customize. Now you can see I look at revenue, earnings per share, book value. Let me show you here. I already got it here. Revenue, earnings per share, and book value. I like to look at book value per share actually. Okay, so these three things. You can search for other things like later we talk about like returns, return on total capital, return on equity, return on asset. It's already been added, but you can actually add more things like return on capital. It will be here. So I'm going to take this away, update fact sheet, and let's take a look at their revenue, earnings per share, and book value per share. Now, first of all, what is revenue? Now, revenue, it is the total amount of money a company earns from the business activity. So by selling products like you see Walmart, they sells like all the groceries or the electronics in their particular store. And whenever customers pay them, it is added to revenue. So if let's say this customer pays $1, the other one pay $50, add up together $51. Another one pays like 10,000, there will be 10,051. And throughout the whole entire year, they will have a total revenue for that year. So let's take a look. Walmart's total revenue for 2024, because the time of recording this video is 2025. We got the latest like 2024 revenue. There's a $648,125. Now, this is not, in fact, not in thousands, it's in millions. So it's 648 billion. That's how much money they've collected this year. One thing important about revenue, you can see the preferred is growing year on year for the past 10 years. I want it to be growing. So let's take a look. Is it growing? 2016, 17, 18, from 482 billion to 485, 500, 514, 523. Pretty obvious it's growing. If you click on it on Jita, they will show you a yellow line. This yellow line doesn't look like it's growing. Well, it's actually growing, but not as fast as we may like. Later, we can take a look at the growth rate. But so far, looks pretty good. Would you like to have a company like this? Would you like to own, like, imagine the whole entire Walmart is yours. Every year, you're making another 600 billion, probably 600 something, and then 700 billion. Well, it's going to be trillion soon, correct? Another couple of years. This is almost predictable. Will they continue to grow at this rate? Well, if they've been growing like this for the past 10, 20 years, what is stopping them from growing? Well, there's only so many people in America, correct? How much can they grow? Don't forget there's this thing called inflation. They can increase prices. And when they increase price, remember, one customer pay $1. Next year, they'll pay $1.50. And the one that pays $50, next year, they'll pay $55 or $60. So just by inflation, the revenue will continue to grow. Now, would that be nice to have a company that matches or beats inflation? Think about it. So this revenue. The next second portion that we look at for profitability is earnings per share. Now, this is in fact one of the most important criteria for myself. Everything is important, but this one, right, actually affects valuation. So later I'll talk about it a little bit more. In fact, the next few sessions. So earnings per share, right, is the company's profit divided by all the shares. So we can see that the net income, okay, net income is, revenue and net income is a bit different. Very different actually. So this is the top line, this is the bottom line. Well, this one is a customized section. So it doesn't mean that where I place it is the top or bottom line. But if you look at the profit statement, we mentioned it, I think about 2 sessions ago, or is it 3 sessions ago on Investing University. We talk about income statement. So the revenue is how much money they collect from their customers. They still need to pay for the manufacturing of the goods. Or if they don't manufacture, they bought the goods from somewhere else. Or they have to pay for their salaries. They pay for maintenance of their stores. All this, after minusing all the costs, net income is only here. That's pretty bad. They're only making $15 billion. Okay, by the way, if you can't tell from the sarcasm, 15 billion is a lot. Okay, so it's pretty good. They are making $15 billion. So this amount, net income, net income is divided by the number of shares, which is 8 billion shares. So 15 billion divided by 8 billion number of shares that's in the stock market. Every single share is a 1.91. So if you're holding one share, that one share entitles you to $1.91 of profits from Walmart. It doesn't really entitle you, it's attributed to you. It's like, okay, this is your portion of the profit this year. Doesn't mean you can extract $1.91 if you get one share. Okay, it's whether they have the policy of giving you dividends. Okay, so this is earnings per share. Same thing for earnings per share. You can see the preferred is growing year on year for the past 10 years. So you see that profitability, we like to look at past 10 years. Why is that so? Because we want to see whether they have the records of being able to make money consistently and growing. So let's click on this. Oops, look at this. For Walmart, there are certain down times, going up, back up, and then, well, they're recovering, but it's almost like a flat line. Take that in mind, note on that, and then let's see whether is it still a good company. Generally, it's not making any losses for the past 10 years, still making money every year. In fact, this is a pretty down year, 2019. Then that's pre-COVID. Something happened this year. Okay, we can go and investigate more. But right now, you can see we will prefer some companies that is like nicely going up the earnings per share. The last I would say matrix I look at for profitability will be book value. So book value is the net value, the net asset value minus liability. It's like their net worth. So essentially, what would be left for the shareholders if the company were to be liquidated? So again, this is the net worth of the company. So I'm going to look at net worth per share because we want to take the net worth divided by the number of shares, and I want to see that it's growing. So you can see 2016 is $8.49 per share. It's growing steadily all the way until $10.40. Pretty good sign, okay? Some drops here and there, but generally the net worth is growing. Now, same thing. Would you like to actually like buy a company where the net worth is growing? That's my answer is I would love to. Okay, so this is profitability. So I do hope this makes sense to you guys. And this is the first check. If a company is not even profitable, let me see, is there any company I can think of that's not profitable? Let's take a look at Ford Motors. Okay, so you can see Ford Motors, the earnings per share, it is not as stable. Book value per share, okay, pretty decent, flat line. But generally, we want companies that is like making money more and more. So it's like we talk about like I would say the Magnificent Seven, like Meta or Microsoft. Okay, you will see that their revenue or earnings per share, it's pretty strong. Okay, look at the revenue, straight line up. Earnings per share, straight line up. Book value per share, straight line up. Okay, so these are very, very good signs. So remember, when we are choosing company to invest in, after latte factor, we find money to invest in, we have to allocate our money to the place that is most, I would say, growing the best, right? With a certain steady rate and also safety. So these are the things we look at. Let's go back to Walmart. All right, this anyway, Walmart, again, like I mentioned, it is not advice to buy or sell, it is just a case study. So after profitability, the next thing we look at is cash flow. Look at two things, free cash flow and operating cash flow. Free cash flow is the cash a company generates from its operation after subtracting a capital expenditure. Capital expenditure, right, is for maintaining or expanding assets. Like for Walmart, they need to maintain their warehouse, they need to maybe clean up their car park and things like that. All these, right, they decided that, well, every single year, the company generates certain amount of cash. But if they need to spend a lot of money to maintain the warehouse and things like that, there will be very little free cash flow left. Free cash flow is cash that's excess. So every year we have like additional excess cash that we don't really need to actually upgrade or maintain the business. So these are money that it's like almost shareholders can extract them and the company can continue to operate. So this idea of free cash flow. Now, free cash flow, we prefer them to be mostly positive for the past 10 years. Where do we find it? Same thing. Let's go back to Jita. Let me see. Free cash flow. So let me go to custom. Free cash flow. Okay, let's add free cash flow per share. And then the next one we look at is operating cash flow. Now, operating cash flow is different from free cash flow in operating cash flow. Cash flow. Okay. Cash flow from operations. Cash flow from operating activities. Okay, you can see it's here. It's already been added. So let me update the fact sheet. Let me find free cash flow from operations. Cash from operating activities. Let me just shift this up as we are looking at all this. Okay, update this. And you can see that operating cash flow means the cash generated from the company's regular business. Now, sometimes businesses make money when they sell away a plant or they invest in some other companies. We want to know whether this company's main business is making money. So I look at these two, operating cash flow, and those money that they make from operation, like investing or selling away their plants, it will flow into free cash flow. So it's a good check and balance. Okay, so we have these two to guide us to see whether this company indeed have cash or not. So let's take a look. Does Walmart have cash? This is cash from operating activities. So, well, now what I'm looking at is positive for the past 10 years. Every single year is making money, and have additional money, real actual money from their operations. Second portion, free cash flow. Now, this free cash flow per share, so it means that every single share, if the business continues to operate, we are in fact able to extract these shares. No, okay. Technically, we are not able to extract, but the principle of it, there's additional excess cash. This is important, isn't it? Imagine your living expenses. There's no additional cash for you every single month because this month's income is to pay for every single thing and you are left with nothing. That's scary, correct? So free cash flow is almost like ability to save this amount of money. So you can see it's positive every single year and that's a good sign. I think I added another free cash flow here. So free cash flow per share, all this, it doesn't matter is it per share or free cash flow. But for me, I want to see positive every single month. Okay. So later we can take a look at some other examples. Let me just take a look at, let's say, Xpeng. Xpeng is a new company, a flying car, EV car. Let's see the cash flow. You can see that cash flow from operating activities is a negative. So this is not really a healthy sign. It is not a fundamentally, I would say, stable business. It is a very small startup, very new startup. I would say small. They are pretty big right now in China, like $4 billion. But you can see their revenue, but cash flow wise is negative. So it's not exactly the model answer to invest in because you know that you are buying a company that is not able to have additional money every single year and they are not able to make money from their operations every single year. Well, disclaimer, if you want to purchase into companies like this, personally, I was very interested in their technology and just like a vote of support, I bought some shares, but it is not the bulk of my portfolio. Okay, just probably like 1 or 2 shares, or did I buy a long-term call? So this is the whole key idea. So this is a contrast, okay, Walmart versus, let's say, another company. So this is cash flow, and it's important for companies to make money and have cash as well. Now, third one, liquidity. We do not want company that borrows too much money. Two metrics to check liquidity or whether they are borrowing too much money. The first one is debt to equity ratio. This is a measure of companies' financial leverage calculated by dividing, okay, the total liabilities, meaning you say their debt, how much money they owe people, compared to the shareholders' equity. This is their net worth. So the preferred is less than 50% in the current period. Let's take a look. So this is a Walmart, and you can see that I have put it here. Okay, debt to equity ratio. Now, debt to equity ratio, remember, what we want is less than 50%. So in JITA, they do not give percentage, they give a certain ratio. So the ratio is 1.93. 1.93 means that their debt is 1.93 times more than their equity. So let's quickly take a look at their equity. We have this thing called book value. Shareholders' equity is $83 billion. So if you look at their total debt, let's see whether we can find their total debt. Total debt. Let's also look at total liabilities. Total liabilities. Okay, let's update this and then compare it to their shareholders' equity. Right here. I'm going to pull this all the way out, do a comparison, and that's where you can see where does debt to equity come from. Debt to equity ratio. So this is pretty good, right? You can actually pull things here and there and compare it immediately. Okay, let's update the fact sheet. You can see this is a shareholders' equity, okay, 83 billion, and the total liability is almost 2 times more. Can you see? It's almost 2 times more. This is how you get the debt to equity ratio. What it means is your net worth is 83 billion, but how much you owe people is 161 billion, almost 2 times more. Not very comfortable. So this is something minus point. Now, does that mean that we straight away do not invest into Walmart or a company that's high debt to equity ratio? Well, this is a minus point. I will say it's a minus point. Meaning to say later we look at this whole thing as a checklist. So if let's say they pass certain criteria with plus point, certain with minus point, and overall we form a picture. Okay, it's not like immediately we strike them off. Because another thing that we can look at is the interest coverage ratio. Debt to equity is how much debt or how much liabilities they have as compared to equity. But you must understand, some of these liabilities do not have interest. What we are very concerned about is in event your company is making money every single year and 1 year it doesn't make money due to certain issues, you do not have enough cash to pay even the interest of the debt. Does it make sense? And if you don't have enough cash to pay the interest of the debt, that's where the debt will compound and that's where you go bankrupt. However, if let's say the debt is very low, okay, it's a plus point. If the debt is pretty high, let's look at the interest coverage. In fact, we'll look at both anyway. So interest coverage is how easily a company can pay interest. Very, very important. On its outstanding debt. It's calculated by dividing operating income by interest expense. So if let's say my operating income, example, is $100 million, and my interest every single year is $50 million. So meaning to say every single year, I make $100 million worth of money, and out of this, half is to pay my interest. So there's only a 2 times coverage. So meaning to say, whatever I make this year, I can pay 2 years of interest. What we want is we want our company, the one that we are potentially going to invest in, to have the ability to pay at least 10 years of interest with 1 year of income. Whatever I make this year can pay at least 10 years of interest. So let's take a look at the interest coverage ratio. Okay, so coming back to here, interest coverage ratio, let's see, yes, it's over here, interest coverage. So this number shows the number of times you can pay, 9 times, 9 times, 8 times. We want to look at the most current one. Okay, why? I'll explain in a moment's time. But right now we can see it's 10.1 time. 10.1 time, it's pretty good. Okay, well, Walmart can easily pay off their interest, even though they have huge liabilities. But in fact, the actual interest is not so much that they cannot handle. They can easily pay 10 times. So if this year I don't make money, it doesn't matter. Last year's money can cover the next 10 years. So even if I don't make money for the next 2, 3, 4, 5 years, interest will not be so much of an issue. Okay, if with 1 year of profits. Now, why do we only look at this year and not like the past 10 years record? Same thing. For debt to equity, we are only interested in the current year. Because whatever debt they have in the past, maybe initially they need more money to expand, but they already pay off all the debt, or they already like managed to negotiate for very low interest. At the point where we are investing into them, this is the state of the company that they don't need a lot of debt and they don't have a lot of debt. Well, we can actually purchase because of that. The past debts already like sort of settled, doesn't really bother us so much. In the future, if they suddenly have a lot of debt and their interest coverage isn't doing so well, that's where we can consider like divesting, sell away some of them. Does it make sense? Okay. So this is liquidity. Okay. Wow, nice drawing. So this is what we are looking at: debt to equity and also interest coverage. So remember, yeah, at least 10 years of current interest. Okay, next one. So the fourth segment, we're looking at efficiency. Now, efficiency, I look at 2 metrics. Okay, the first matrix is margins. The second matrix is return on equity. This first one, margin. So margin, right? Let me show you. You see, I have a gross profit margin and net margin. So margin, right, it is very essential because it shows you whether this company is in fact a strong company. Why do I say that? Last time I used to study this concept called economic mode, and I realized that margin can give you a very good snapshot or good idea whether this company in fact has economic mode. Now, what are margins? Okay, margins is very simply the revenue. Where's my revenue? Okay, here. How much money they collect from the customers. Now, if they collect like $600 billion from the customers and they have to pay so much money out, they like spend so much like salary, or like in fact there's not much profit left, right? You will see that the margin is very low. Now, let me just share with you that in fact for Walmart, their net margin is not really high. You can see that they are making 600 billion. After paying everything, they are left with 15 billion. Their net profit margin after tax, after paying everything, it's only 2.4%. It's pretty thin. So if let's say they don't make so much money this year, the income may be wiped out, maybe gone. Can you see that? So this particular supermarket business is not something that's high margin. One particular reason is this. Most of the things that they sell is not produced by them. They purchase from, let's say, Coca-Cola, they mark it up a little bit, and then they sell it to the customers. This is their main business. They are like a distribution business. So the margins is not high. So does it mean that it's a bad business? We need to actually compare it to their industry peers. But if let's say their net margin after paying tax, everything is about 10%. So if they are making 60 or rather $600 billion, they are left with 60 billion. That's pretty, I would say, decent, right? So imagine you do a business, you collect $1,000 from your customers, and at the end, right, you don't even have $100. Isn't that terrible? So I don't know, maybe if you sell a MacBook and from Apple and you're exclusive distributor, very likely you're going to get less than 10%. That's my imagination. So we want a business that's decent, high margin, more than 10%. Otherwise, if you still want to invest in this company, you have to make sure that it's higher than industrial peers. Another company that has a low margin. Okay, but before that, let's take a look at companies that have generally higher margin. So let's go to Jita. Let's go to, let's say, Meta. Oops, you can see that Meta Corporation is not here. Let's go to Facebook. Is there Facebook? Okay, Meta. Oh, there's no Meta. Okay. Is it called Meta? Okay. Never mind. Oh, Meta Platforms. Meta Platforms. Okay, Meta. Okay, so you can see you need the company's name. So let's take a look at the margins of Meta. So you can see this Meta, their margin, net profit margin is 37%, pretty consistently over the years. So whatever money that you pay Meta for advertisement, they are taking at least almost near 40% in net profits after paying their staff. I don't think they pay badly. Okay, it's just that they are very efficient in their ability to make money. Can you see that? So when we talk about efficiency, we look at net margin, we look at gross margin, and we compare across industry. Okay, so very important because a company that's strong, they are either able to control their costs well, economies of scales, they can actually like really buy things really cheap, produce things really cheap, and their margin will be higher. Otherwise, they have very strong branding and they can charge very high. I think Meta has very strong branding because their network like effect, their ability to have so much database in Instagram, in Facebook, in WhatsApp gives them that advantage. So they are able to have a high profit margin. Very, very efficient. You can see that. At least more than 10%. This company, 34%, or 37%, I'm sorry. Okay, and every year it's making more than 10%. If they can make more than 20, it's even better. So this is the comparison. Now, for Walmart, I would like you to compare it to other, I would say, supermarkets, okay? So example, this one is Singapore supermarket, Sheng Siong. You can see, okay, let me just refresh it because we have changed some of the fact sheets. The net profit margin, it is in fact, I would say, a lot more efficient than Walmart. Well, maybe because they sell goods that is almost near expiry. There's a different business model, but it's working, correct? You can see 7%, 8%, 10%. So in fact, after I look at this, oh, Sheng Siong is not doing that bad. It's pretty good in terms of efficiency. Okay, but remember, we've got to check the rest: profitability, cash flow, liquidity, efficiency. Well, they are doing a good job. So you can see gross margin. We don't look at like salary. We don't look at tax yet. So this only shows the amount of goods when they sell the goods. How much money are they making? So overall, initially, you can take a look at both gross margin, net margin, and compare it against their competitors. So this is something that we look at. Okay, so Walmart versus, let's say, Sheng Siong. So you look at Walmart, gross margin about 20%, 25%, 27%. And for Sheng Siong, okay, which is a supermarket in Singapore, it is about 25% to even up to 30%. You can see that Sheng Siong is a lot more efficient. Maybe not a lot more. It's more efficient. It's correct. So this is the way that we look at it. Again, not saying that we should buy Sheng Siong or we should not buy Walmart. It is for us to compare. Where do you want to put your money? In a company that's more efficient or less efficient? So efficiency, this is one portion. Second portion is return on equity. Okay, let me explain what's return on equity. This is something that I would say I've heard Warren Buffett, Charlie Munger talking a lot about it. But they don't look it, they don't mention return on equity, they say return on total investor capital, which is very similar. Okay, there's slight difference, but the whole idea is this. Equity is the net worth of the company. So the net worth of the company, as the company increase their net worth when they make more money, they can either return it to us or they can actually use it to run the business, expand the business. So if they don't give it back to us, if they retain it, to run their business, we want to make sure that the returns, if you keep my equity, if you keep my net worth, make sure you are using it well. So what are we looking at? We are looking at least give us a 15% returns. Make sure that if you are holding $1 million of my equity, your profits, okay, should be 15% of that 1 million, which is 150,000. Okay, so this is the whole key idea. Okay, so if I calculate wrongly some of the numbers, please pardon me. So let me show you this. Same thing from here. Okay, do I have return on equity? Okay, you can see is return on equity is here. For Sheng Siong, okay, the return on equity, you can see 25%, 25%. Well, I mean, as I look at this looks more and more attractive. Okay, anyway, 25%, 30%, a very efficient company, okay, because they are, I would say, using our equity well. So the equity, which is here, shareholders equity, was that? Shareholders equity, 400 over million dollars. Using that, they are generating net income of 133 million. So because they hold our equity, they can generate this amount. So this is the whole idea of a return on equity. Now, again, maybe they are not using that whole amount, but well, because of the fact that they are holding this amount, they are using it, they are expanding their business, they are using it to actually purchase more inventories. At the end, they generate us at least 15%, but now it's 28%. It's considered pretty good. Let's take a look at Walmart. Walmart, we can see shareholders' equity is $83 billion. Net income, 15 billion. How much is that? We can see that the return on equity is 19%. Pretty good as well. And for the past 10 years, it's more than 15% most of the time, except for 3 years. But even then, it's not too far. Except for 2019, we know that they didn't make as much. But you can see it is pretty good at generating money using our money that we actually they are holding on to. So this is efficiency. Again, compare across in industry, but you can see right here, I put at least 15% for the past 10 years and or growing. If it's growing, it's even better. Any of them growing? Let's take a look. Okay, so return on equity is decent, it's flat. Okay, I think because Walmart is also a very stable company, it's pretty flat. Okay, if we look at a company like Amazon, let's take a look. Interested to see. They are also like a super big supermarket and more now. Okay, they are more than a supermarket. Again, disclaimer, vested. So very quickly, we can take a look for Amazon. Now, first of all, we talk about efficiency. Gross margin, 48%. Net profit margin, you see, initially it's 1%, 4%, 5%, 7%. Okay, and it seems to become more efficient over the years, 9%. Remember, it's also like a retail store, but mainly online, correct? So, well, I would say that it is not the best in terms of margin, but they are doing pretty decently. They're doing well. In fact, improving. For return on equity, 14%, 12%, all the way up to 17, 24%. Now, there are years that even the great Amazon will also fall. Their cash flow is also negative on some points. So it's a minus some points here, but generally, most of the things are looking at well. Okay, later we do take a look at Amazon as a whole. So this is talking about efficiency. Now, last portion, we look at growth. Why do we look at growth? So remember the first 4 portions, we look at a few things. We look at profitability, where we check out their revenue, their earnings per share, and well, these companies are making money. Well, the next portion is we look at cash flow. Is there really money? Show me the money. Positive cash flow, very good. Okay, it's here. This is Amazon. No, sorry, this Walmart. So we have cash flow. Then the next portion, we look at liquidity. Are they having too much debt? So looking at certain ratios, too much debt. But you look at the debt, 63 billion, sounds like a lot. But compared to the equity, not really. It's manageable. Okay, so we look at the debt to equity ratio. We look at interest coverage ratio, these two. And then we look at the next portion, efficiency. There's return on equity, and we look at net profit margin. Last portion, this company seems to be sound, but are they growing fast enough? Now, unfortunately, Jita doesn't have a growth for many things, but they do have certain things like revenue per share, cash flow per share, earnings per share, dividend per share. So these are good benchmark annual rates of change for the past 5 years, 1 year, 3 years. Okay, so you can see revenue for Walmart has been growing at 6.2%. It is right under here. Okay, this is not customizable. They've already given us some of the key figures. Okay, revenue per share, free cash flow per share is becoming negative. Earnings per share, wow, 20% for the past 5 years. Okay, but again, this is 20% annual rates of change. So it's like 20% per year for the past 5 years. Dividend per share and book value per share. So it's highly decent. But you can see book value per share, past 1 year is 9%, 3 years 2.9%, 4%. So we see every blocks of 1, 3, 5 years, this matrix should be growing. So there are some other metrics I look at: revenue growth, income growth, EPS growth. So revenue growth, as mentioned here, earnings growth, earnings and EPS growth, typically roughly the same. If you want to go a little bit more in depth, you can go to Morningstar, search for Walmart. So let me show you how to do that. Walmart, Morningstar. Click on this. It is easier to search for the companies in Google rather than this search tool. This is my experience. And you can go for key matrix. Under key matrix, here there's a growth rate. They give you a little bit more because they have 10 years, 5 years, and 3 years. So you can see for Walmart, for the past 10 years, their revenue grow at about 3%. They do not have the latest in 2024. 3% growth, that's how much your money will grow typically when you invest in Walmart. So take note of that, because as the value of the company or the net income, you see the net income 10 years average is about minus 10%. Well, this is not very good. You can see but 10 years is minus, 5 years 18. So you look at it as a whole. But the nearer it is, it shows like a overall growth rate as well. So let me give you an example. Okay, example, earnings per share, percentage, right? Past 10 years, they grew at 1.62%. Past 5 years, 20%. 3 years, slow down, year on year, 34%. So I like to look at the whole entire thing as holistically. So you will see like the particular trend. So 10 years ago, I mean, compared to 10 years ago, seems like it is not super growing extremely fast. But in the recent years, it's growing faster and faster. Okay, probably like 10 years ago, it was quite high, have a dip, and it's growing back. Okay, so 5 years ago, probably there's a dip. Let's take a look at this. You see, there's a huge like a change, right? 20.54. Earnings per share. Okay, probably they measure from here, 2019. So 1 year, 2 year, 3 year, 4 year, 5 years. So from 0.75, 1 year growth, 2 year growth, 3 year growth, 4 year growth, 5 year. So for the past 5 years, it's pretty strong because there was a dip in 2019. So we have to investigate this even further. So let's take a look at Sheng Siong as a comparison. Same thing. We can see that they are growing. Earnings per share, let's take a look. 12 years, not 12 years, 12% for 10 years, 13%. Last 3 years seems to slow down, and year on year seems to slow down. This actually is pretty concerning if you do not realize that, because it shows that for the past 10 years, they look good. 5 years still look good, but the past 3 years and the year on year, it doesn't look as good as it seems. Okay, so let's take a look at Amazon. I'm using both Morningstar and Jita concurrently. Amazon, you can take a look. Past 5 years, revenue growth, past 3 years, and past 1 year. Seems to be a slowdown in revenue per share. Can you see that for Amazon? Free cash flow, there's a dotted here, probably some missing information. Don't be too concerned. You can just go and take a look at it. Earnings per share, this is amazing. Okay, 36%, 19%, 90%. Okay, so there's a huge spike in earnings per share. There may be some extraordinary earnings, like they sell away certain portions and things like that. Book value per share, very important. This one shows the stability of the company. Very stable. 10 years, 5 years, 5 years, 3 years, 1 year, still 30%. So overall, looking at this, very strong company. And when I look at the 30% growth rate for book value, likely this is how much, if I put my money in, I can expect them to grow not too far from this rate. Now, if let's say they are only growing 1-2%, don't expect your money to grow by 20-30%, unless you can buy them really undervalued. So I do hope that this helps. You can read through the slides again and use ChatGPT, augment it with your Google search to increase your knowledge. So overall, I came up with a spreadsheet again for this segment. There's a investing university matrix, and revenue, earnings per share, book value, all this. This is the preferred criteria. This is the definition. Then you can see they are all together 12 matrix. Okay, you can see 13 here because the first one is, I would say, the header. So there's a 12 matrix. You can give each one a point, and there are certain things that's non-negotiable actually. So if let's say the first 3, they're not even making money, that's actually, why do you want to invest in a company that's not making money? However, if they are not making money, you will see that the growth matrix will also be terrible. So if you give it a certain point system, 12 out of 12, you may want to do something like, at least they must pass 8 out of 12, right? If they're not even passing 8 out of 12, why would you want to invest in it? So that being said, let's go through a last example. Okay, so example, let's look at Microsoft. So, and then we use this matrix to look at it. Okay, revenue. Is it growing year on year? Earnings per share, book value. Let's take a look at these 3, and then we can give it a point here. So let's take a look at revenue. I think we saw it just now, correct? Revenue is increasing, earnings per share is increasing, book value is increasing. Is it increasing? Book value is increasing. So let's go back here. If you are doing a matrix on uh, Microsoft, 1 point. Pretty good. Okay, free cash flow and operating cash flow. Mostly positive for the past 10 years. Free cash flow, where's that? Free cash flow. Okay, it's here. Well, one look we can see is positive for the past 10 years and also operating cash flow from operations. Where is that? Here. Cash from operations. Yeah, it is both growing. So another couple of points. 1 point for Microsoft. Let's take a look at debt to equity and interest coverage. So for Microsoft, debt to equity, again, for this one, let me just remind you guys, we are looking at the current period, current year. Okay, so debt to equity, where did I put it here? Okay, debt to equity is 0.91. It is preferred to be 0.5. So this one, I'm going to give it 1 point less, 0 points. Okay, and then the next one, interest coverage. Scroll down here. Interest coverage more than 10. Now it's 36. Okay, easily can pay back their interest. That's another point for Microsoft. Next one, gross margin. I'm looking at net margin more than 10% and higher than industry peers. So for Microsoft, who is their industry peers? They seems like a monopoly. That's why they're getting a lot of issues with the law. But let's take a look. What was I looking at? Was it net margin? Okay, net margin 36%, very consistently for the past 10 years. In fact, growing. Okay, this is pretty good. Let's take a look at return on equity as well. Return on equity. Okay, here more than 15%. Now it's growing at 30%. Wow, very, very good. So again, I want to say that I'm biased. Okay, not really. I'm looking at the matrix, right? But I'm vested in this company. So please do not buy or sell because of what I say. Do your own homework. Okay, so revenue growth, income growth, EPS growth. Let's take a look. Oops. Actually, revenue growth and income growth is okay. So revenue growth, past 5 years, 3 years, 1 year. Can you see very consistent? I can expect my money to grow maybe probably at 15% if I invest in Microsoft at the right price. We'll talk about the right price soon. Earnings per share growth, 18%, 13%, 21%. Let's take a look at it on Morningstar. Microsoft Morningstar, key matrix, growth. Okay, so let's take a look at the latest revenue growth. Okay, we can see even for the past 10 years. Oh, in fact, it's growing faster than the past 10 years. Seems to be growing. Net income, very stable company. EPS, very stable. Wow. Looks attractive in terms of the quality of the company, but we have not taken a look at the valuation. But so this is how I do it. And then if you do a sum of it, okay, it's 11 points out of 12. Not a perfect company. Boom. Okay, but the whole key idea is at least you have a good sensing. And I would actually, for myself, I look at a company that passes most of the criteria, at least 8 out of 12. And if let's say they don't even pass 8, right? I'm going to look for the next company. So this is how I do it. I do hope that this has been useful. I will put this link, okay, this particular spreadsheet into the description and also into the Telegram. So I do hope that you have learned something today. So this investing matrix, it is something that I've been using for years. It has evolved, but most of the matrix are still here. So investing university, today we talk about, okay, not 10. In fact, we have 12 financial ratios or 12 numbers. Not all of them are ratios. And next week onwards, we'll be talking about valuation. After we find a good company, wow, 12 out of 12, 10 out of 12, 11 out of 12. When do we buy it? We can look at valuation. If you actually like this particular series so far, remember to subscribe, like, share with your friends, comment below what else you want to learn. If you disagree with me on certain areas, feel free to comment as well. Because I'm not an expert or I know everything. It has been useful for me. I make mistakes sometimes as well. But together we'll learn and we will improve. All right, I'll see you in the next Tuesday where we talk about valuation. Remember to stay safe and position size because sizing is everything. See you guys around.